Welcome everybody. This is a session where hopefully we answer some of your questions, or at least kick the ball around talking about potential growth opportunities in the market. I'm Matthew East. I am the head of hotels at Gowling WLG, and I shall just introduce you to our esteemed panel. So Navneet, do you want to introduce yourself and tell us a bit about your company?
Hi. Yes, of course. Till recently I was involved with a company called Mininger, which is in the hotel hostel hybrid space, and I've launched a company called LyvInn, and it's about living and having also a hotel space. So it's a mixture of co-living and hybrid hotels. So it's residential as well as transient, mixture of both accommodations. And the idea is to build that across Europe in vibrant cities where are targeted young people who want to rent rather than buy. They're professionals, graduates, and they can share that space in a co-living environment where there's a lot of experiential collaboration and experiential where they can actually work from there as well as play. So it's live, work, play, but it also combined with transient accommodation, such as you get in a hotel, a budget hotel. So it's a mixture of transient as well as residential.
Fantastic. Thanks, Navneet. Andrew.
Sure. So I work for FREO Group, which is a pan-European investment and asset management business. We focus on commercial real estate historically, but have started to do a lot more hotel work recently. So this is across Germany, France, Italy, Spain, Switzerland, the UK, and in fact in the US. Our interest in the hotel, my background in Europe has been with the building up the Adina business mainly in Germany. Joined FREO to start working more in the hotel space. And as part of that, we've looked at the way we want to do this and acquired an interest into Michelle's & Taylor, which is a hotel operating platform. So we now see ourselves, hopefully, as a full-service hotel partner for our investment partners, where we can basically go from the very beginning, sourcing and analyzing deals, through the negotiation, branding, development, asset management, and as and when needed operations across Europe.
Thanks, Andrew. Fantastic. And Frank.
Yeah, Frank Hildwein. I'm running the hotel acquisitions for the Deka group. Deka is the fund manager of the German savings banks, and we have a total portfolio of about 45 billion, and about 10% out of that is invested in hotels. So we have about 70 hotels in total, and except for 2 hotels, which are in the US, all the rest is spread around Europe. One particular thing we have within our regulations is that we can only invest into leases. So we are not able to take operational risks in our funds, and do depend on operators to run our assets.
Thank you all. So I think, shall we get down to it? Obviously, it's, as everybody's been talking about throughout the morning, we are faced with a very difficult and challenging environment. One of the things that we find interesting as lawyers, we constantly have clients sort of asking us where we see the market. It's so nice to have everybody in front of us to actually share your views, and we can give some answers back. There seems to us anecdotally to be a lot of interest from our clients coming forward, looking on the buy side. But equally, when you look towards activities and deal flows and what you hear the valuers saying, obviously the market is very, very dead and quiet. I mean, do you think with this basically squeeze in terms of the lack of buyers and the market not showing its data, Frank, at the moment, do you see an environment whereby in the short term you would be interested in entering into the market and actually buying assets?
Well, actually, we try to keep on investing also in these difficult days. So with our various funds, so especially our retail funds, the open-ended funds, they have still a large amount of liquidity, and we are not so dependent on debt. So we can also, if it makes sense, we can buy equity only. So a big limitation for sure is the availability of debt. But also we see that the hotel market is really, really quiet. So if you want to sell a good asset right now and you want to go to a wide market, you probably don't get the feedback you would want to see on your asset, and you can't be convinced that you get the best price in. So therefore we see that a lot of processes have been pulled back and waiting maybe for Q3 or Q4 to restart. But especially during Q2 and now over the summer, I don't expect that we don't see many transactions, and this might also continue. So we are prepared to do something, but of course the big challenge, and that's the second point, is that the evaluation of the hotel performance. You know, what do you do? So what kind of return levels do you expect? What kind of cash flow do you expect from a hotel to do over the next years? That's really the key question. Either we invest into leases, but also if you do management agreements, you want to see that a certain GOP level has been reached, and that's very difficult to underwrite.
And interesting, everybody on the panel has sort of pan-European experience. Andrew, in terms of, as Frank has just sort of explained the market at the moment, do you expect certain markets and jurisdictions to be coming back sooner? Obviously, there's been a varying effect and impact of the pandemic. We've seen some hotels in Greece and some of the less affected states now opening. Do you see opportunities varying by jurisdiction?
I think a very interesting question is the difference between what's the consumer issue versus what's the investor issue here. Consumers will go back to certain products at certain times, and I think we can, we've all heard about how Spain had the biggest day on record of selling holidays when their market opened up last or the week before. And certain products will recover. I think from my perspective, I think longer term, what the consumer does is probably less of a problem, because I think people will go back to traveling the way people did ultimately in the future, maybe at a slightly lesser extent, I don't know. What's interesting to me is the way the investors, and I'm very interested to hear what Frank's saying and actually to understand how he's pricing it, because I think the biggest problem is pricing, and what the lack of data, the lack of comfort with pricing means that regardless of what we think is going to be the situation in terms of which product will recover more quickly, I think there will be a general flight to quality in investors' minds. And I don't know if, Frank, that would resonate with you, but investors that we are seeing are very much focusing on security, on core locations, on really, really good quality assets, on good quality management. And we perhaps talk a bit later about how we're analyzing this, but certainly in terms of do I see a particular sector, be it leisure or budget or business or whatever, recovering more or less or quickly? I don't think that's a question I can answer today. I think ultimately they will all recover to a strong degree. I think what's really interesting is where are people prepared to put their money at the moment? And to my view, that's very much focusing on quality real estate locations and quality assets and quality management.
Yeah, I fully agree what you say, Andrew. It's definitely a more focus on core assets, but even if you don't apply a big discount on yield, then still the sustainable income of a hotel investment which you underwrite today is lower than 2019. That's for sure. So if you capitalize the lower cash flow, then you come up to a discount, which is probably, I don't know, 10, 20%, 25%, and that's difficult for a vendor to take. So why should he sell now and not wait until the market has recovered and we can see light at the end of the tunnel? So it's underwriting is the big issue, and that's the reason why I think we won't see that many transactions throughout the year.
Navneet, hearing what Andrew Frank have said, I mean, do you see when the market returns, do you see it looking different in terms of shape or structure of deals or what people are going for, or do you see things continuing developing back into its sort of pre-2019 state?
I think definitely there is a change, and then any disruption, and this is a big disruption, as it's happened in the past. When you have disruption, it accelerates whatever's going on in the world. So I think looking at very short term, there may be opportunities, as Frank said and Andrew said, because there may be some distress or stress and somebody has to sell, you get as a cheaper. Of course, if you don't have to sell, you wouldn't want to sell 20% below your current value, if you like, before the COVID. But there may be situations where you're forced to sell. So there may be opportunities for those kind of situations. But in the medium to long term, I think the acceleration will be there of trends that are already happening. For example, when I was in mining, there was a trend that there was a shift towards the hybrid hotel hostel, where you had higher return per square meter than the other hotels. And mining had the highest return per square meter of any hotel in the world. I mean, I can tell you that. And I've been in this business for 32 years. And that may have stopped short term, but it'll come back. But even so, I think the other trend that we do see is, which is happening here, is because of the way people are going to work in the future, the way people are going to travel in the future. So obviously less business travel, leisure will still be there, but people will tend to travel more domestically in the short term, perhaps. And but quality, as Andrew said, would certainly be a key thing. I think the other key thing will be operations, the quality of operations. It's not the asset so much as the operation itself, and the quality of management. That will become a key aspect of underwriting, because nobody can take away, and that's what this conference is about, operational real estate, because ultimately it is about the operation. It's about how you operate, what kind of markets you're serving. So those kind of things will become more focused. For example, I'm looking at co-living now. The trend, and this happened in the earlier sessions, people wanting to rent more than to buy when it comes to living in a city. That trend will probably be accelerated. So I think acceleration is the thing.
In terms of the quality of management that you all have spoken about, do you see that going hand in hand with potential always brand partnerships? There's been quite a lot of talk in the market about brands giving consumer confidence, and therefore, as an owner, would you be looking to pair that management expertise with brands? Andrew?
I think it's a very interesting question here, and actually something that would be great to also get Frank's point about is what's the value of a covenant today compared to what it was 6 months ago. And I'm sure if you looked around Europe and putting brands aside perhaps, but the covenant of the operator, be that a brand or an independent, it's becoming, I think, a lot more difficult. And the markets, I don't know how this is all going to play out, but I would feel, I suppose, it's highly likely that brands will become more valued because they put a stability into the investment a piece. But I think we were at risk. We don't want the market to become too dominated by big brands and the operators that they support. I think we have the last 5-10 years has done very well with a large number of independents coming up, both in terms of brands and operators. And I hope that we find a way to support that and make that continue. And I don't know, but I suppose I do believe that brands will become, unfortunately, perhaps more important and more dominant over the next couple of years as this flight to security and safety kind of continues. But it's just a view. I don't know, Frank.
Well, I would say that, you know, in the most cases in our portfolio, we don't have a lease contract with a brand. We have a lease contract with a franchisee, with an operator who operates the assets. So, you know, if we operate it under one brand or another brand, it might make a difference, but it's more important to have a good relationship to that specific tenant and to the business concept overall. And what we can see right now is that people behave differently. So you know, in some cases they continue paying their rent. Others, they don't at all. You know, even they had fantastic years over the last 5 years, and they have aggregated a lot of cash flow, but now they have stopped paying rent. So it really depends, and that might change also the market. How reliable is your business partner? And that's, from my perspective, not so much dependent on the brand, because they just don't jump in. You know, if you have a Marriott franchise, and we have a relationship with the tenant, Marriott is not going to pay the rent of the franchisee.
Yeah, my own view, if I may say, Matthew, is, you know, this is a financing decision, whether you buy or lease ultimately, and how that is, you know, financing covenants will change and things will change. So I think the fundamental thing is how people are behaving, and what kind of products are people going to want in the future, and that's the real key to understanding consumer behavior. That's the underlying. How you finance it. In Germany, it's leases. In other places, they're management contracts. I don't think financing sits on top of the underlying operations. And what's key is which are the sectors which are going to do better than the others. Clearly, in my view, budget is going to do better. Clearly, luxury resorts are going to do well. Is the middle is going to get squeezed, as always had. Post 2008, 2009, that's what really happened. So, and there's a move to value, and that's why budget. There's no doubt that leisure will always do well, particularly domestic leisure, and then increasingly as international flights come back with the flights, then you have international travel as well. So those are things that impact the overall situation as to where the growth. I mean, we're talking about where the growth is. I think that's where the growth is going to be, and how it's financed, I think, is a secondary matter. Personally, you know, whether you take a fund like Frank's, or you go and do a OpCo ownership structure like APG does with, say, the student hotel. I think that's a financing issue.
Matthew, there's a good question, very interesting, asked there by James Devitt, which is relevant to this, which is where will values be in 2020 relative to 2021? In other words, are we going to see this continual slide? Is it going to bounce back or what? I think it's a very interesting point. And to my mind, there's two different answers to it. One of them relates back to the sort of the quality issue we were talking about. And the other one is a more macro issue, which I'm probably not qualified to comment on. I genuinely believe we will see a larger spread in values between high quality, well-managed, well-located assets in whether it be a city centre or a top quality resort location or whatever it is, to some of the more fringe properties. And so the spread of values across hotels, I think, will increase going forward, and that may make opportunity there for the right, in the right circumstances. But also at a macro level, I don't think we've yet seen half of the fallout that's going to happen here. And we all know, we're all sitting, and as everybody's said, and it's just not telling anybody they don't know, there's not a lot of product coming to the market today because people are not in a highly motivated or pressured situation to sell yet, but I'm sure it will come. So whether prices go up or down next year relative to this year, I think will depend upon the balance of that, but also this whole issue about where your asset is located. What kind of an asset is it? Is it a good quality? Is it a bad quality asset? What budget sector is it? Is it budget? Is it mid-market? Is it upper market? Is it in a prime trophy location, or is it in a marginal location? I think these will all have an influence on price, and so we're going to have to get very granular in our analysis to make good investment decisions going forward. And I think this is going to be much heightened now. We can't just sit back and rely on a covenant or whatever it was. If it's a poor quality hotel, it probably will, or location, it probably will suffer going forward.
Yeah, it's just so difficult.
Go ahead, Frank.
Yeah, thanks. It's just so difficult to do any kind of valuation right now. So most people we are talking to think that the market might have recovered more or less in 2023. So, but what can you expect out of that recovery? Do you get back to 2019 levels, or do you get to 80% of 2019 or 90%? So that's really the key question. And until then, it's so difficult to do valuations. And until then, I think also we will not see that many transactions because of that issue. And so what do we do in our portfolio? We do not really strongly value down the assets now and value them up again in a couple of years. So we keep it not stable, but we do moderate down valuations until we have clarity where the market is going to be, and that's the tough.
So Frank, what kind of asset would you truly consider to buy today? Because I fully appreciate the problem. We've all got the same issue. How do you value? So you've got good liquidity, huge resources, so on. I mean, would you actually buy a hotel? I mean, what would be the thing that would make you want to buy something if it came to market today? I put you on the spot here, didn't I?
Yeah, no problem. So in reality, what kind of asset can you expect to come to the market? So you either have situations where investment funds are selling. Would they sell their trophy assets today at a discount price? I'm not sure if they would. Who else could be a vendor? Maybe an owner-operator who gets into distress, no cash flow from operation, might has to unlock some equity and bring an asset to the market. Is that going to be a trophy asset? Maybe not. So we don't see many opportunities which would fit our investment criteria, the criteria nowadays. If we go out and underwrite an asset and pay a strong yield on it, then it has to be something really, really trophy. And but we don't see these assets coming to the market right now. Maybe they come in Q3 or Q4, but it's probably more off-market situations which we see, because as I said before, you don't bring your best asset to the market and don't get the feedback you want because of COVID right now and the lack of data and transparency and evidence.
Frank, in terms of, obviously, one of the things that you've said in terms of your investment market, you're looking at always lettings. Obviously, in terms of the demand that you're going to see from your side, that needs to be underpinned by a strong letting demand, or a demand for people to take essentially the operating risk. Speaking to your tenants, where are they seeing the market? Are they completely out, or are they still wanting to look at the right opportunities?
Interesting question. I don't have a real answer to that. It's if you look at the larger operators which have a lot of leases, like Spanish groups, which really have difficulties right now, or Motel One, which are probably doing a bit better, have a better situation. Do we see the same amount of leases in the future? It depends on the market, really. In Germany, probably yes, because you don't get finance from most of the banks on management agreements. In other markets, France and UK, probably even less leases than you have today, depending also on the segment. Maybe the Premier Inns are still remaining on leases, but will you get a lease on a luxury 5-star plus hotel? Probably not.
Got another interesting question here, and one from Navneet. Obviously, given that COVID has been more serious, more prevalent around densely populated sort of city areas, she's asked, do you see a more divergent set of development for hotel resorts, rural locations cropping up? Even, I suppose, when you talk about the UK market, sort of staycation resort hotels.
Yeah, I think it's a very, very good point. Will there be a demand for that kind of project? I 100% believe in countries like the UK, where you've got a relatively affluent population, particularly when you look at the London sort of hub, and the potential to travel far to previous years. I think that will put a great pressure on or be a business driver for the domestic travel market. And I'm not telling anyone something they don't already know. The key problem to me in this is the availability of finance. So I believe, from what we see, from what our investors partners are saying, whatnot, I think that there's and the banks, there's going to be it's going to be a big issue to leverage and to get equity for new developments in hotel space going forward. I think that will definitely slow things down. And just to give an indication, I mean, our own projects, we've had debt levels come down from development from sort of 75%, even higher, down to sort of mid 50s into the 60s. So there's, the banks are going to be very, very tough for a few years, and I think, to Frank's point, part of that is driven by the valuations. Nobody really knows where we're going to end up.
I think obviously when the replacement costs are much higher than, if you like, new build is much more expensive than replacement, which is likely to be the case in the next few years. It's very unlikely that you'll have new build coming in. It doesn't make sense, right? So you'll have either conversions or repurposing of space be converted, no longer feasible. Changes in the marketplace or its situation, or an existing, some other residential building or office building, particularly, where you may need conversion. But I think new developments will be quite difficult to finance, because why increase supply by hanging up in most cities before COVID, right? In general, there was an oversupply situation coming in. People were expecting a slowdown anyway. So that's accelerated that event. So I think new developments, I agree with Andrew, will be quite difficult to finance. And I think from my own experience now, talking about my new project, there's a wall of equity waiting for new developments which are going into new markets or looking at how things will fundamentally change in the future. The panel was, do you see a lot of repurposing of buildings where, there could be that happening as a growth strategy?
I think, Navneet, just to pick up on that point, though, I think that's very interesting. And certainly we have held that view should hold true, I suppose. But to be honest, to try to find projects that you can buy at significantly less than replacement cost is still not there. So it will be interesting to see what happens in the future. I mean, or should I say, it's not there in the markets where you would want to buy.
That's because you're saying there's a big bid-offer spread just now between, as Frank was saying, between what somebody wants to pay and he thinks is reasonable because of the future as he sees it, and what an existing buyer owner wants to sell for. I mean, there's a big gap, obviously, in that bid-offer spread. And I speak to the brokers, the large brokers. They're expecting that once government subsidies and all the other support goes away, including support for lessees, etc., which might happen in the next quarter rent payment, for example, September onwards. They expect the situation to become much more, I wouldn't say fluid, but more interesting from the point of view of bid-offer spreads. Is that something you see, Andrew and Frank? Or?
What we're seeing is that anything that is on the market now is basically a property that is probably not of the highest quality anyway, and anybody's in trouble was going to be in trouble anyway. And I think this goes to my earlier point about, I don't think the fallout has yet arrived. And so I think there's more likely to be a lot more action in 2021 than there will be in 2020. But to be honest, so as a result of which, we're not today seeing this plethora of assets that, and I'm talking about Spain. Italy's perhaps slightly different, but Spain, we've got a project in Greece as well. Germany, definitely not. France, not really either. There's just not this sort of plethora of assets coming to market that you can buy for 20% below replacement cost yet. So if it happens, great, but I just don't yet see it.
Yeah, we don't see that either. And but I'm actually glad that not so many projects are coming to the market anymore. You know, if we have seen Germany over the last years, then in some markets we had an increase in stock of 20-25% coming up over the next 2 or 3 years. And that pipeline has probably reduced significantly, which is really healthy for the overall hotel market. So on one hand, there are not so many projects I can buy, but on the other hand, of course, it's healthy for the operational market. And I also don't see that you can buy these at a big discount from a developer. I don't know how that could work. You know, he has signed on an ongoing development. He has signed general contractor agreements. He has its cost, and can he realize that discount? Maybe not. So he probably rather keep it for another while until the market has recovered instead of selling it right now for a discount.
In terms of the role funding plays, obviously, in opportunities, we've seen over the last few years the use of the income strip lease being used to sort of fill gaps or create value where it may not be in the capital stack. Do you see those basically devices largely not being used in the next couple of years? And so in that sense, is the market just going to move towards the very well capitalized where low leverage is key?
Perhaps I can answer. One of the things that we're looking at is effectively what's the right word for it? It's a funding platform to assist asset-backed, good quality opco-propco hotel businesses, and so that's effectively providing some sort of recap facility. The reality is that there will be a lot of businesses who would, I'm sure, appreciate some level of short-term liquidity to deal with this whole situation. The reality at the moment is that it comes back to this point about data. We're not yet, I think, ready to invest into that space because we're not sure where these businesses are actually going to end up. And I think the leverage question, pref equity type stakes in deals at the moment are probably quite, I think, more risky than they were in the past. And I suppose from our perspective, the reason we're interested in it is because we have the Michels and Taylor team with us, and we can do a little bit more in-depth analysis that we might be able to as a normal investor stroke developer. But even still, at the moment, it's still quite it's untested waters. There's no real pricing there to help us, to guide us through this, and we don't know where we're going to end up. So we're being very, very cautious.
Yeah, we are talking only about hotels here, but you know, if you look at the co-living space, for example, which I'm looking at now, you know, the co-living models there are quite a few now across the world. They were doing 100% in Singapore, even in London. They've been doing 85% right through this whole piece. So that's what I'm looking at, is, you know, looking at where the market is, so we can blend it between a co-living space and a hotel space, which will come back, but it might take 4 years, it might take 3 years, depending on where you look at it, right? So if you blend it, then you obviously have a return which is much safer, more likely to give you a safer yield, if you like. And so I think this is where, you know, having a hybrid approach to organizing a real estate comes in, And this lesson should prove that that's where investors should put their money in, because it's safer if you have a blended product, which gives you, both residential, if you like, which is safe, and hotel element. So a mixed use, I think, is the place which will be more exciting, and a lot of investors would think of that, in my view, and that's the feedback I'm getting. That's more exciting for them.
And Navneet, that also leads into this question from Khaled there about repurposing. It's perhaps a bit sad to say in this forum, but we're actually looking at 2 projects at the moment where we are repurposing from hotel to other uses, because they actually have higher and better use as alternate uses. So yes, I think that there is an opportunity in repurposing in the very short term. I don't think that's a long-term strategy, but I think short-term there is.
Just getting.
Why wouldn't you say it's a long-term strategy?
I think the biggest problem at the moment in the hotel space is lack of data and uncertainty, and so people are being inherently cautious. No one is going. You can't underwrite the value add today that you would have 12 months ago in a deal. People are just not going to believe you. If you project value, room rate growth, occupancy growth, all we're going to see is the potential for room rate decline and the potential for a growing, reducing margins through increasing expenses. Very, very difficult to underwrite value add type deals. So, yeah, that's the logic.
Chaps, I just thought it would be nice just to get through. We've had a nice amount of responses, and thank you to everybody for their questions. Just wanted to pick up on the remaining ones that we haven't. Question from Catherine Cheng at Bank of East Asia. Hi, Catherine. She says, what do you think will be the future of cruises? And I suppose in terms of bricks and mortar, there is the knock-on effect also to hotels which service the overnight sort of cruise guest, as it were. Anybody on the panel want to take that one?
Sorry, I didn't get the question. I didn't hear it. The first part.
In terms of, do you think there is still obviously a future for cruises in the short to mid term, and obviously the assets that go off the back of that and trade off the back of that?
My own view is that the cruise business is obviously the short term going to be in real trouble. And, people are talking about going in a cruise as being in a petri dish of some kind, right? So anything else, it will come back, but people will be very cautious about being in a petri dish.
No, absolutely, Navneet, and I think thanks for that question there. Daniel Bowen asks, in terms of hybrid lease arrangements, so obviously where there is a mix of operational and fixed income, it's a perfect question for Frank, actually. Do you see in your world moving across where there is some form of turnover or top up as a hybrid arrangement, or do you still require fixed income long term?
Well, we do have a number of hybrid leases in our portfolio, and I think this is one way to manage the current situation, the current uncertainty, that you just set a lower rent and you participate in an upswing in the market, in some growth. That's maybe a way to conclude a deal in the current environment. But then, of course, you have a lower rent, which you can capitalize. And that also has a pricing impact. But maybe you can also agree with a vendor or developer, you can agree an earnout. If you see that 2023, you have better revenues, you have better NOIs. And yeah, it's something which we are looking more closer at, and if there are deals coming up, then a hybrid lease is for sure a good option.
Matthew, I think it would be interesting to link that question also to what I think is a very good point from Theodore Kubak about perhaps looking at resetting some of the traditional points that we've had or traditional tenets we've held in the industry. I think the at the risk of upsetting some brands, I think that there's a lot of inefficiency in parts of our system, and that's perhaps a little unfair to the brands, but through I'm not pointing at them, but to the whole operation of hotels. We have lots of layers, and we're taking a lot of money out before the owner gets their return. I think this will be a trigger to review that. Both the brands, the online providers, the GDS system, so on. It's perhaps a good time for us to take stock and say, okay, well, how can we make this entire process more efficient? And that will then come down also to the operations on site. And do we slightly modify the way we operate the hotels to, over time, become more efficient? There's no doubt we're going to suffer negative reaction from the investment community going forward. There's no doubt we've got the risk of reduced revenue and increased cost. So as an industry, I think it's very important that we do rethink some of these, as Theodore says, who's taking what out of the system to make sure that we actually have a very viable and vibrant.
Most hotel sessions we go to in the past, we'll always be talking about the technology side and how Booking.com and everything, the biggest slice of the pie, right? And actually, we haven't really talked about that. Now we're so COVID dominated, and since there's no revenue, so nobody's worried about how that revenue is coming through, right? In the future, I think it'll accelerate the technology side, the distribution side. Whatever was happening is going to get even more accentuated, if you like, and therefore there'll be more important, if you like, to use technology for the back end as well, not just the front end, to make it more efficient. So I think that happening in technology being used more efficiently for the back end as well as for the front end, and the idea of getting closer to the customer directly and more efficiently will obviously become more important when revenue is less and costs are in question.
So Navneet, would you see the as things start, as revenue starts to come in, do you see an opportunity to renegotiate possibly with the OTAs, because they're obviously going to be feeling as much of the pain as everybody else? Do you see there's an opportunity to renegotiate some of those fees and look at alternatives?
Look, I just give when the 2001 recession took place post 9/11, that's where the OTAs grew suddenly, because the hotels, needed revenue, and they thought this was not a zero-sum game. They were going to get more revenue by giving a contract to Expedia at 35% margin, right? That's not going to happen now, because people realize that they can actually get to the customer directly themselves. My own view, I'm a great pal of the OTAs. A business like Meininger would not exist if there wasn't Booking.com or Hostelworld.com. So I'm a great supporter of the OTA. I think often they're seen as a villain of the piece, but actually the market has expanded with new brands coming in because we've had these great technologies like Booking.com, etc. there. So I think they will stay there. Margins might change depending on supply and demand. It is already happening. Marriott apparently has done a contract, according to a hotel analyst, at 8% margin just before the COVID. So margins had dropped, if you like, to some extent already. So probably that's a trend, because new people are coming in. Google might come in. Other suppliers, Amazon might come in. So the other technology players might come in and create more competition, if you like, for Booking, etc. But there's a big role to be played by the so-called wholesaler, if you like, and the retailer. It's like a supermarket versus a retail. That's how I look at it. The supermarket is the Booking.com. Therefore, I need my own brand. I also need to have my product placed in a supermarket. So you need both, actually. But it depends. If there's only one supermarket in town, obviously the margin is going to be higher. But if they have more,
I think we are just about out of time. Thanks to everybody else who's been obviously feeding in the questions. That's really helped a discussion. Thank you, Andrew, Navneet, and Frank. It's been a pleasure. Thank you, everyone.
Thanks, Matthew. Thanks for organising.
Thanks, everyone.
Okay.
Thank you. Bye.